so that the room for questions, etc., are minimized considerably. So therefore the statement is a bit long. I request your patience, and I would also request you to please be patient till the end, because towards the concluding paragraphs I have tried to give some forward guidance. In view of the COVID-19 pandemic, the Monetary Policy Committee decided to advance its meeting, which was originally scheduled on 31st March and 3rd April, and the announcement was due to be made on 3rd April. We decided to announce it to 24th, 26th and 27th. Accordingly, the MPC met on 24th, 26th and 27th March and undertook a careful evaluation of the current and evolving macroeconomic and financial conditions, and of course the outlook. I wish to take this opportunity to express my sincere thanks to the MPC members for responding so quickly. I also wish to place on record my appreciation of all the staff and officers of RBI for their excellent cooperation in facilitating this. After extensive discussions, the MPC voted for a sizable reduction in the policy repo rate and for maintaining the accommodative stance of monetary policy as long as necessary to revive growth, mitigate the impact of COVID-19 while ensuring that inflation remains within the target. While there were some differences in the quantum of reduction, the MPC voted by a 4-2 majority, that is by a 4:2 majority, to reduce the policy repo rate by 75 basis points to 4.4%. I repeat, the rate cut decision is 75 basis points, and accordingly the repo rate stands reduced from 5.15% to 4.4%. Simultaneously, the fixed rate reverse repo rate, which sets the floor of the liquidity adjustment facility, that is the LAF corridor, was reduced by 90 basis points. I repeat, 90 basis points to 4%, thus creating an asymmetrical corridor. The purpose of this measure relating to reverse repo is to make it relatively unattractive for banks to passively deposit funds with the Reserve Bank, and instead to use these funds for on-lending to the productive sectors of the economy. It may be recalled that during the month of March so far, the banks have been parking close to rupees 3 lakh crore on a daily average basis under the reverse repo, even as the growth of bank credit has been steadily slowing down. This decision and the advancement of the MPC has been warranted by the disruptive force of the coronavirus. It is intended to, 1, mitigate the negative effects of the virus, 2, to revive growth, and above all, number 3, to preserve financial stability. We are living through an extraordinary and unprecedented situation. Everything hinges on the depth of the COVID-19 outbreak, its spread and its duration. Clearly, a war effort has to be mounted and is being mounted to combat the virus, involving both conventional and unconventional measures in a continuously battle-ready mode. Life in the time of COVID-19 has been one of unprecedented loss and isolation. Yet, it is worthwhile to remember that tough times never last. Only tough people and tough institutions do. In the recent period, Reserve Bank has been in action on a daily basis with efforts to alleviate financial stress, build confidence and keep the financial system sound and functioning. And we have taken a number of steps over the last 1 month or so since the conclusion of the last MPC meeting. In my statement, I have listed out the measures which have been taken. For the sake of time, I am not reading it out. Once the statement is uploaded, I think those who are interested can have a look at it. Let me assure that the Reserve Bank is at work and in mission mode, monitoring the evolving financial market and macroeconomic conditions and calibrating its operations to meet any need for additional liquidity support as well as to undertake other measures as may be warranted. It is our effort to ensure normal functioning of the markets, nurture the impulses of growth and preserve, I repeat, and preserve financial stability. Incidentally, we have in RBI quarantined 150 members of our staff and service providers together with the IT facilitators and the entire IT facility as a part of our business continuity plan. The plan was prepared and executed in a matter of days. The MPC noted that global economic activity has come to a near standstill as COVID-19 related lockdowns and social distancing are imposed across a widening swath of affected countries. Expectations of a shallow recovery in 2020 from 2019's decade low in global growth have been dashed. The outlook is now heavily contingent upon the intensity, spread and duration of the pandemic. There is a rising probability that large parts of the global economy will slip into recession. Turning to growth in India, the implied GDP growth of 4.7% in Q4 of 1920 in the second advance estimates of the National Statistics Office, which was released in February 2020, within the annual estimate of 5% for the year as a whole, is now at risk. As regards the outlook for 2021, apart from continuing resilience of agriculture and allied activities, most other sectors of the economy will be adversely impacted by the pandemic, depending upon, I repeat, its intensity, spread and duration. We have to recognize that the government has taken timely and appropriate measures to contain these three factors, that is to contain intensity, spread and duration. And let us all cooperate with the measures announced by the government to deal with the problem, to prevent the spread of coronavirus, to contain it and win this war. If COVID-19 is prolonged and supply chain disruptions get accentuated, now these are risk factors which I am listing out. It all depends how we respond to the situation. I am just listing out the risk factors. Only time will tell how effectively we have acted as a nation and how effectively we have been able to contain the spread of coronavirus and how effectively we have been able to restrict its adverse impact on our growth. So if COVID-19 is prolonged and the supply chain disruptions get accentuated, the global slowdown could deepen with adverse implications for India. The slump in international crude prices could, however, provide some relief in the form of terms of trade gains. Downside risks to growth arise from the spread of COVID-19 and prolonged lockdowns. Upside growth impulses are expected to emanate from monetary, fiscal and other policy measures and the early containment of COVID-19. As regards inflation, the prints of January and February 2020 indicate that actual outcomes for the quarter are running 30 basis points above our earlier projections, reflecting the onion price expected to emanate from monetary, fiscal and other policy measures and the early containment of COVID-19. As regards inflation, the prints of January and February 2020 indicate that actual outcomes for the quarter are running 30 basis points above our earlier projections, reflecting the onion price shock. Looking ahead, food prices may soften even further under the beneficial effects of the record food grain and horticulture production, at least till the onset of the usual summer uptick. Furthermore, the collapse in the crude prices could work towards easing both fuel and core inflation pressures depending on the level of pass-through to the retail prices. As a consequence of COVID-19, aggregate demand may weaken and ease core inflation further. Heightened volatility in financial markets could also have a bearing on inflation. Given this heightened volatility, unprecedented uncertainty and extremely fluid state of affairs, projections of growth and inflation would be heavily contingent on as I earlier said, the intensity, spread and duration of COVID-19. Precisely for these reasons, the MPC decided to refrain from giving out specific growth and inflation numbers because the situation is fast changing and the outlook is extremely uncertain. In fact, this kind of uncertain outlook has never been seen before. And as I mentioned earlier, I would again like to repeat that if we, all of us, every citizen, every person who lives in this country, if we follow the rules, if we follow the advices given by the government and other authorities, then as a country we should be able to win this war against COVID-19, in which case much of the worries that we have in our growth outlook would get considerably reduced. The MPC noted that macroeconomic risks both on the demand and supply side brought on by the pandemic could be severe. The need of the hour is to do whatever is necessary to shield the domestic economy from the pandemic. The Government of India has yesterday announced a number of measures which are expected to provide relief to various disadvantaged sections of the society. The MPC further noted that the Reserve Bank has taken several measures to inject substantial liquidity in the system. Nonetheless, the priority is to undertake strong and purposeful action in order to minimize the adverse macroeconomic impact of the pandemic. It also underscored the need for all stakeholders to fight against the pandemic. Banks and other financial institutions should do all that they can to keep the credit flowing to the economic agents which are facing financial stress on account of the isolation that the virus has imposed. Market participants should work with regulators like the Reserve Bank and the SEBI to ensure the orderly functioning of markets in their role of price discovery and financial intermediation. Strong fiscal measures are of course critical to deal with the situation. To summarize, COVID-19 stalks the global economy and the outlook is highly uncertain and of course negative. Several nations are battling its exponential contagion. Countries are shutting down to prevent being sucked into a kind of black hole. Authorities all over the world are mobilizing on a massive scale to fight an invisible assassin. India has locked down economic activity and financial markets are under severe stress. Finance is the lifeline of the economy. Keeping it flowing is the paramount objective of the Reserve Bank of India at this point of time. The time has therefore now come for the Reserve Bank to unleash an array of instruments from its arsenal to staunch and mitigate the impact of COVID-19, revive growth and above all, preserve financial stability. The aggregate action and stance of MPC provides a befitting launching pad. In turn, the configuration of initiatives unveiled in the Statement on Development and Regulatory Policies, which I am now going to spell out, amplify the MPC's decision and leverages on it as well. Accordingly, it is appropriate that the MPC's decision and the other actions which I am now going to elaborate upon should be regarded as a comprehensive package with force multipliers. The developmental and regulatory policies can broadly be delineated under 4 categories. First, measures to expand liquidity in the system sizably to ensure that financial markets and institutions are able to function normally in the face of COVID-related dislocations. 2. Steps to reinforce monetary transmission so that bank credit flows on easier terms are sustained to all those who have been affected by the pandemic. 3. Efforts to ease financial stress caused by COVID-19 disruptions by relaxing repayment pressures and improving access to working capital. And 4. Endeavor to improve the functioning of markets in view of the high volatility experienced with the onset and spread of the pandemic. I would announce them in broadly 3 sections. The first section relates to liquidity measures. A multi-pronged approach comprising both targeted and system-wide liquidity provision has been adopted to ensure that COVID-related liquidity constraints are eased. The first announcement relates to targeted long-term repo operations, TLTRO. Let me elaborate further. Large sell-offs in the domestic equity, bond and forex markets have intensified redemption pressures. Liquidity premia on instruments such as corporate bonds, commercial papers and non-convertible and debentures have surged. Financial conditions for these instruments, which are used inter alia to access working capital in the face of the slowdown in bank credit, have also tightened. To mitigate the adverse effects on the economic activity leading to pressures on cash flows across sectors, the Reserve Bank will conduct auctions of targeted long-term repos of up to 3-year tenor of appropriate sizes for a total amount up to rupees 1 lakh crore at a floating rate linked to policy repo rate. Liquidity availed under the scheme by the banks has to be deployed in investment grade corporate bonds, commercial paper and non-convertible debentures over and above the outstanding level of their investments in these bonds as on March 25, 2020. Eligible instruments comprise both primary market issuance as well as secondary market purchases, including from mutual funds and non-banking finance companies. Investments made by the banks under this facility will be classified as held to maturity, HTM, even in excess of 25% of the total investment permitted to be included in HTM portfolio. Exposures under this facility will also not be reckoned under the large exposure framework. The first auction of rupees 25,000 crores under this arrangement will be conducted later today. The relevant notification in this regard is being issued separately. The second announcement under the liquidity measures includes cash reserve ratio, CRR. It is observed that despite ample liquidity in the system, its distribution is highly asymmetrical across the financial system and starkly so within the banking system. To help banks tide over the disruption caused by COVID-19, it has been decided to reduce the cash reserve ratio, CRR, of all banks by 100 basis points to 3% of net demand and time liabilities, that is NDTL, with effect from the reporting fortnight beginning March 28th for a period of 1 year. This reduction in CRR would release primary liquidity of about rupees 1,37,000 crores uniformly across the banking system in proportion to liabilities of the constituents rather than in relation to their holding of excess SLR. Furthermore, taking cognizance of hardships faced by the banks in terms of social distancing of staff and consequent strains on reporting requirements, it has been decided to reduce the requirement of minimum daily CRR balance maintenance from 90% to 80%, effective from the first day of the reporting fortnight beginning March 28, 2020. This is a one-time dispensation available up to June 26, 2020. The next announcement relates to marginal standing facility. In view of the exceptionally high volatility in domestic financial markets, which brings in phases of liquidity stress, and also to provide comfort to the banking system, it has been decided to increase the accommodation under the marginal standing facility, MSF, from 2% of the statutory liquidity ratio, SLR, to 3% with immediate effect. This measure will be applicable up to June 30th, 2020. This measure should provide comfort to the banking system by allowing it to avail an additional rupees 1.37 lakh crore, that is 1,37,000 crore of liquidity under the LAF window in times of stress at the reduced MSF rate announced in the MPC's resolution. These three liquidity measures relating to TLTRO, CRR and MSF will inject a total liquidity of 3,74,000 crore to the system. 3.74 lakh crore to the system. We have also decided to widen the monetary policy rate corridor. Let me elaborate. In view of persistent excess liquidity, it has been decided to widen the existing policy rate corridor from 50 basis points to 65 basis points. Under the new corridor, the reverse repo rate under the liquidity adjustment facility would be 40 basis points lower than the policy repo rate as against the existing 25 basis points. The marginal standing facility rate would of course continue to be 25 basis points above the policy rate. The second set of measures relate to regulation and supervision. That is basically certain regulatory measures. Alongside liquidity measures, it's very important that steps are taken to mitigate the burden of debt servicing brought about by disruptions on account of the COVID-19 pandemic. Such steps in turn will go a long way to prevent the transmission of financial stress to the real economy and ensure the continuity of viable businesses and provide relief to borrowers in these extraordinary times. Under these measures relating to regulation, the first measure is with regard to moratorium on term loans. All commercial banks, including regional rural banks, small finance banks and local area banks, cooperative banks, all India financial institutions and NBFCs, including housing finance companies and microfinance institutions, that is all lending institutions basically in the system, are being permitted to allow a 3-month moratorium. I repeat, all the lending institutions are being permitted to allow a moratorium of 3 months on payment of installments in respect of all term loans outstanding as on 1st March 2020. The second measure under this relates to deferment of interest on working capital facilities. In respect of working capital facilities sanctioned in the form of cash credit, overdraft, lending institutions are being permitted to allow a deferment of 3 months on payment of interest in respect of all such facilities outstanding as on 1st March 2020. The accumulated interest for the period will be paid after the expiry of the deferment period. The moratorium on term loans and the deferring of interest payments on working capital will not result in asset classification downgrade. The next announcement relates to easing of working capital financing. In respect of working capital facilities sanctioned in the form of cash credit, overdraft, lending institutions are allowed to recalculate drawing power by reducing margins and or by reassessing the working capital cycle for the borrowers. Such changes, I repeat, such changes will not result in asset classification downgrade. The moratorium on term loans, the deferring of interest payments on working capital and the easing of working capital financing, which I just announced, will not qualify as a default for the purpose of supervisory reporting and reporting to credit information companies by the lending institutions. Hence, there will be no adverse impact on the credit history of the beneficiaries. The next announcement relates to deferment of implementation of Net Stable Funding Ratio, NSFR. The net supervisory reporting and reporting to credit information companies by the lending institutions. Hence, there will be no adverse impact on the credit history of the beneficiaries. The next announcement relates to deferment of implementation of Net Stable Funding Ratio, NSFR. The Net Stable Funding Ratio, which reduces funding risk by requiring the banks to fund their activities with sufficiently stable sources of funding over a time horizon of 1 year in order to mitigate the risk of future funding stress, was required to be introduced by the banks in India from 1st April 2020. It has now been decided to defer the implementation of NSFR by 6 months to 1st October 2020. Deferment of last tranche of capital conservation buffer. That is the next announcement. The capital conservation buffer CCB is designed to ensure that banks build up capital buffers during normal times, that is outside periods of stress, which can be drawn down as losses are incurred during a stress period. Considering the potential stress on account of COVID-19, it has been decided to further defer the implementation of the last tranche of 0.625% of CCB from March 31st, 2020 to September 30th, 2020. With regard to financial markets, that is the third part of the announcement, we are announcing one measure, and this measure basically assumes importance in the context of the increased volatility of the Indian rupee caused by the impact of COVID-19 on currency markets. And this relates to permitting banks to deal in offshore non-deliverable rupee derivative markets, that is basically offshore rupee NDF markets. The offshore Indian rupee derivative market, that is the non-deliverable forward market, that is NDF market, has been growing rapidly in recent times. At present, Indian banks are not permitted to participate in this market, although the benefits of their participation in NDF market have been widely recognized. The time is apposite to improve efficiency of price discovery. Accordingly, banks in India which operate International Financial Service Center IFSC banking units, that is IBUs, are being allowed to participate in NDF market with effect from June 1st, 2020. Since last MPC meeting and let me now come to the concluding part, and this is very important because I have attempted to give some forward guidance, so I request your patience. Since the last MPC meeting of February 2020, the Reserve Bank has injected liquidity of 2,80,000 crores, 2.8 lakh crore through various instruments, which is equivalent to 1.4% of our GDP. Together with the liquidity measures announced today, RBI's liquidity injection works out to about 3.2% of the GDP. The RBI, I repeat, the RBI will continue to remain vigilant and take whatever steps are necessary to mitigate the economic impact of COVID-19 and preserve financial stability in the country. As I had stated earlier, all instruments, I repeat, all instruments, conventional and unconventional, are on the table. Before I conclude, let me reiterate that the Indian banking system is safe and sound. In recent past, COVID-19 related volatility in stock market has impacted share prices of banks as well, resulting in some panic withdrawal of deposits from a few private sector banks. It would be fallacious to link share prices to safety of deposits. As I have mentioned in my earlier interaction with the media, depositors of commercial banks, including private sector banks, need not worry on the safety of their funds. I would therefore urge members of public as well as various public authorities who have deposits in private sector banks not to resort to any panic withdrawal of their funds. Their funds are safe. In conclusion, let me say that in spite of the very challenging environment, I remain optimistic. It is worthwhile bearing in mind that the macroeconomic fundamentals of the Indian economy are sound and in fact stronger than what they were in the aftermath of the global financial crisis of 2008-9. The fiscal deficit and the current account deficit are now much lower. Inflation conditions are relatively benign, and financial volatility measured by change in stock prices from recent peaks and average daily change in exchange rate of the rupee is distinctly lower. COVID-19 is upon us, but this too shall pass. We need to remain careful, take all precautionary measures. I leave you with this comforting thought: stay clean, stay safe, and go digital. Thank you very much.
The press conference by the RBI Governor Shaktikanta, a host of big announcements being made by the Reserve Bank of India to tide through this COVID-19 crisis. So yesterday, Nirmala Sitharaman, Finance Minister, came out with a slew of measures for the poor and marginalized. We're hoping for an announcement for the economy as well, an economic stimulus in due course. But today, the RBI coming forth with huge announcements, repo rates being cut by 75 basis points, reverse repo rates being slashed by 90 basis points. Also, a moratorium, a deferment, if I may call it that, of loans, of EMIs for 3 months. For all banks, for all sorts of loans, there is a 3-month moratorium that has been given. So in a way, that means that there is a 3-month deferment of your EMI payments for the next 3 months. That's a huge relief for, of course, consumers and customers of banks across the country. Also, CRR reduced, the cash reserve ratio reduced. That will infuse more liquidity in the system. So slew of measures with relation to, of course, the repo rates, the LAF rates being announced. Also, CRR, SLR changes have been made, as well as this 3-month moratorium for all long-term loans, short-term loans and interest payments has been made, and which is effective from this month onwards. So from the 1st of March onwards, it is effective. So of course, it applies to those payments which you would have been expected to make next month onwards. So slew of measures announced by the RBI, and the RBI has said that these are not the last measures. They are monitoring the situation. They will take any extraordinary or extraordinary step given the unprecedented nature of the current crisis. Let me bring in Mr. Chandrasekhar, economist, joining us on the broadcast. Appreciate you speaking with NewsX. Your first reaction to these big announcements made by the RBI?
Oh, absolutely. I think these announcements, these measures are absolutely welcome. They are timely. Probably they could have come a week earlier, but nonetheless, better late than never. There are 3 things. I think we need to move simultaneously in several different directions to keep the economy afloat. One part is to contain the virus. Second part is to support daily wage earners and individuals. The income support program was announced yesterday by the FM, and today the RBI has come up with its some kind of a rescue package from a money or finance perspective, interest perspective. These are welcome. But I would expect at least latest by Monday, the government comes up with a stimulus package for the corporate. That will be the 4th kind of leg for the economy to stand on. But today's announcements are very good. Liquidity enhancement, cut in interest rates are going to be quite positive. But one small, what should I say? I would have expected a very specific provision to support SMEs and MSMEs. After all, they are the backbone of India's economy. 64 million units in operation, creating jobs and incomes and contributing to export. I think SMEs and MSMEs need to be treated with a little more leniency. That probably will happen through internal administrative instructions, but I would have expected the governor to say at least one line, advise the banks to be more lenient and more friendly towards MSMEs. But overall, I think it's a very positive policy measure from the RBI governor.
Okay, but fair enough. At the end of the day, perhaps we can expect that from the government. Nirmala Sitharaman was specifically asked what the government is planning to do for that sector. You spoke about, sir, the SME, the MSME sector, and she said, let's leave that for another day. Yesterday's focus was the poor, the marginalized, the farmers. So perhaps indicating that the government could do something for that sector in due course. Meanwhile, you spoke about, of course, the rate cut and, the CRR aspect, but what about the loan, aspects, the moratorium on loans, literally the RBI governor stopping the clock for the time being for the next 3 months?
Right, that is true. I think which is okay. The moratorium on loans is something which is important, and that would obviously help individuals and corporate and business houses to to enhance their current liquidity, but it's only postponing a liability by 2 or 3 months. Therefore, I don't think it's going to have such a substantial impact on economic activity.
Okay, and at the end of the day, of course, Mr. Shaktikanta, how will this be taken by the markets? I think the markets will perhaps boom as a result of this, these announcements by the RBI. They reacted positively yesterday to the finance minister's announcements. How will the markets react and the rupee to this speech by the RBI governor?
I'm very clear the markets are not going to go ecstatic over these announcements. These were actually expected in some sense. I remember it was last week from the IMC Chamber of Commerce, we sent a major representation to the Government of India, to the PMO, and of course to the Reserve Bank of India, making many of these recommendations that the RBI governor announced today. Therefore, this is not unexpected. What is more important in my view is a big stimulus package for the corporate sector and for various businesses, which we need to wait for until maybe Monday or Tuesday. I don't know when it's going to come. That can potentially prop the markets up.
Okay, and you're hoping that should come sooner rather than later.
Absolutely. All this should have happened a week earlier, but as I said, better late than never. Okay, aaj ho gaya hai. Maybe Monday the stimulus package for the corporates should come up.
All right. Meanwhile, Mr. Chandrasekhan, there is some not good news as well coming in for our Indian GDP outlook. Moody's has cut India's outlook to 2.5% from 5.3%. So Moody's downgrading India's growth story. Moody's cutting India's economic growth outlook for 2020 to 2.5% from the existing 5.3%. How do you view that?
Basically, I think they are exaggerating the loss of output and loss of decline in economic activity. Yes, our economy has been slowing, and it is certainly going to be affected by the decline in activity over the last 2 months and the potential decline in activity probably the whole of April, and hoping that things come under control sometime towards the end of April and the economy starts to normalize by May or June. I'm expecting the markets to rebound in the second half of the year, provided the pandemic comes under control in the next 2 months. But I would think Moody's outlook is a little exaggerated to the downside.
Absolutely, and at the end of the day, what we're seeing is through the announcements, of course, made by the RBI governor today, and from what the finance minister said yesterday, that these announcements are being made for the next 3 months. That does indicate that the government and, of course, those in administration do anticipate the situation perhaps to continue at least for the next 3-month period. This is a 21-day lockdown currently, but given the the unexpected nature of the crisis and the unpredictable nature of the crisis, we're provisioning for 3 months.
So I think that makes a lot of sense. You can't keep providing for 15 days or a month and then keep extending it. I think 3 months is a reasonably good time frame, and there is hope that within the next 2 months or less than 2 months, the entire pandemic will come under control. Hopefully by the end of April, in my view, in which case there will be a review of the situation sometime in June. Therefore, it makes no sense to tell the world that we are giving all these relief measures for the next 6 months or 1 year for the whole of this year. That will create a lot more fear in the minds of people. This is a temporary measure to shore up economic activities. It makes no sense to tell the world that we are giving all these relief measures for the next 6 months or 1 year for the whole of this year. That will create a lot more fear in the minds of people. This is a temporary measure to shore up economic activities and to ensure that livelihoods are not lost, liquidity is improved, and the economy starts to normalize. Therefore, I think the 3-month timeline is perfect. I think it's well thought about.
Absolutely. And just coming back to the RBI announcement, Mr. Chandrasekharan, if we can, you know, we on NewsX have been over the last 3 to 4 days taking viewers' phone calls. You know, we've been indulging in as much information dissemination as we can, in as much, problem busting as we can, and allaying of viewers' concerns and questions. And we've been doing that from literally 6 in the morning to midnight. We've been getting hundreds of phone calls, and a lot of them actually, viewers who I spoke to as well, were talking about this. You know, what will happen to our EMI? You know, what about our EMI? What about our EMI payments, particularly for the small business owners, particularly for those with not too huge an income? Do you believe they will be happy, currently at least, with the RBI's announcement?
Yes, of course. They should be happy because of reduction in interest rate is one. Second, liquidity enhancement is the second one. They will be able to access more funds from the bank on a lot easier terms. And then therefore, I think that should generally make borrowers quite happy.
Okay. And, you know, Mr. Chandrasekharan, your expectations now, I know there are a lot of expectations from industry and from, of course, citizens of the country, from the government. But your 2 to 3 main expectations from this major economic stimulus announcement, whenever it happens in perhaps the next week, from the government of India. You heard what the finance minister had to say yesterday. You heard her earlier when she, of course, deferred the cycle to June for payment of for filing tax returns and whatnot. You've heard the RBI governor today. What are your main 2 or 3 expectations from the FM when that economic stimulus is announced, perhaps in the next week?
What was announced 2 days ago were all administrative measures of extending the time limit for filing returns, etc. But what I expect would come as early as possible is, for instance, moratorium on loan, rescheduling of loans, allowing corporates to access more funds from the bank on easier terms, which obviously is what the RBI governor's press conference today hinted at. And a major boost to exports, primarily probably incentivizing exports a bit more. Fortunately for us, again, crude oil prices are so low now that it's going to bring a bonanza for the government in terms of saving on foreign exchange expenditure. That should become a very positive aspect for our economy, which will keep our inflation under check. Therefore, I think corporates, I don't think should actually expect any more tax relief, etc. I think enough of tax relief has been given. What the corporates would actually need is debt rescheduling.
Okay, debt rescheduling. And of course, some individuals want loan absorptions and debt absorptions, etc. Now, I don't know whether that is feasible for now or not, looking at our fiscal deficit. However, Mr. Chandrasekharan, as far as the CRR announcement is concerned that was made by the RBI governor, do you believe it will infuse more liquidity in the system, and that is also the need of the hour?
Yes, absolutely. It is expected. That's the intention of this CRR reduction, which will infuse more liquidity in the economy. But what is important is the role of banks now. Banks have now been provided with enough liquidity. It is now for the banks to start lending, of course, with appropriate checks and balances, doing due diligence, etc. Banks can and shall no more sit on piles of money and do what is called lazy banking.
So banks should immediately react. Banks should immediately react to this announcement, Mr. Chandrasekharan, is what you're saying, and pass on all these benefits to the consumer.
Yes, onus is on the bank now to start performing and start granting loans with appropriate due diligence and checks and balances, etc.
All right. Well, Mr. Chandrasekaran, economist, appreciate you joining us on NewsX for reacting extensively there to the RBI's announcements. Let me bring in Akash Jindal, economist, who's also joining us on the broadcast at this point. Akash, welcome back to NewsX. Your reading of the RBI governor's announcements.
Massive, I would say massive. I salute the RBI for taking stock of the situation and doing what it was required. I think as a central banker, RBI has done a great job. I mean, we were expecting, I have been requesting on your channel, other channels, regarding a moratorium on loan payments, interest rate reduction, whatever we demanded, most of the things have been accepted. Now, interest rates, repo rate has been reduced by 75 basis points, which means 0.75%. CRR ratio, the banks, the cash banks have to hold, that has been reduced. There's a moratorium on loan payments. Plus, there are certain technical things which actually would be better understood by a banker or finance people. But ultimately, all those things also, which are technical in nature, that also would ultimately help the common man. Plus, the RBI governor has said about private banks that yes, I mean, we shouldn't worry just because the share price of a bank is down. That's what RBI governor has said. So I think overall, the reduction in rate of interest is a huge thing. The nation required it. You would remember on your phonos, I have been requesting for it. I have been requesting, my organization Akashindal.in has been saying that prior to the monetary policy meeting, you do it. They have done it prior to that. They have preponed it and they have announced it. So that's a huge relief to the common man, ordinary citizens, because these are times of distress, these are times of emergencies. We wanted our institutions to stand by us. I, Akash Jindal, economist, salute the RBI for taking these measures. My organization, Akashindal.in, had requested for 3 measures and all the 3 have been done, though the quantum has not been that. Rate of interest, I had requested for at least 1% reduction. It's 0.75, but still, I would
say... So all your expectations, all your suggestions have been heeded to, is what you're saying, Mr. Jindal. You're very happy with the RBI governor's announcement. And, you know, you were with us, you know, if you remember when we were answering some of our viewers' questions, and a lot of viewers were talking about EMI payments. Now with the RBI governor, in a way, stopping the clock for the next 3 months, that's huge relief for the average Indian, the Aam Aadmi, isn't it?
That's what I was speaking about. Now, your callers, mainly the issue, mainly the concern of the caller friends was that how do I pay my loans? And you remember I addressed them that yes, I was very much with them, because see, people didn't plan for that. Now, all those people who were calling on your channel, these were honest borrowers who have been paying their EMIs by now, by all the date, and they wanted to pay. But all of a sudden this lockdown happened and their finances went into a system of confusion. So they were not in a position to pay. So those people, they were actually worried. Now, that's why I told them that RBI may perhaps do something. I requested RBI from your platform also, plus all other news channels, and I'm happy that 3-month moratorium on all loans have been given. Now, this is a huge thing. Wouldn't these be in the times of distress? I would have referred it to as gift, but I wouldn't refer it to as gift. This is an emergency measure. This is an emergency solution. This would reduce the panic, confusion, and the chaos in the ordinary borrowers. Because, see, what has happened is, we have seen almost everybody has been borrowing. People have been borrowing for good reasons, like building a house, buying a car, two-wheeler. And I mean, youngsters, they have been borrowing for lifestyle also. And most of the borrowers were such who had planned it that way, that they'll earn and they'll pay all the EMIs. So all of a sudden this lockout happened and they went into a state of panic, confusion, how to tackle their EMIs. So I think RBI has addressed and relieved them of that stress. That's why I'm saying I rarely do that. I, Akash Jindal, from my organization Akashindal.in, I salute the RBI for this biggest emergency measure which they have taken, moratorium on all loans for 3 months.
Okay,
so people would be relieved of this burden.
Yeah, your suggestions have been heeded too. I have to then quickly ask you, Mr. Jindal, we heard from the finance minister yesterday, announcing that 1.70 lakh crore scheme and announcement for, of course, the poor, the marginalized, the farmers of our country. Today, the RBI governor has made his slew of announcements. Now, all onus on the government once again for a further, stimulus package. This time, though, for the economy, for the industry, for corporate India. What are your main expectations from that announcement, and by when do you expect it to be made? Mr. Jindal? For you. That was for you, sir. Go ahead.
Yeah. So, the yesterday's press conference by the finance minister, it addressed many concerns for our BPL brothers and sisters. Now, for 3 months, some people would be getting ration. There'll be help for the coming 3 months. A huge amount of 1.7 lakh crore has been allocated for them. But still, there are certain suggestions from my organization, akashjindal.in, prior to coming to what the industry need, what the businessmen need. See, the government has planned it very well. The government is out to help the common man, and they are saying that we don't want anybody to stay hungry. That's a very good thing by the government. But the request of my organization, akashjindal.in, is these may start from April. We need immediate relief. So my request with folded hands to the government is that please start food delivery, ration delivery, grocery delivery to each and every household. People like Akash Jindal who can pay for it, they should be charged for this. And all those brothers and sisters who are below poverty line, who can't pay for that, or any family which is in distress because of this, they should be handed it over free of cost. Because my organization, akashjindal.in, and me, we are worried about the supply chain. Would we be able to maintain the supply chain? Because production of many things have stopped, processing has stopped. So in addition to the measures which the government has announced yesterday, these were good measures. I think emergency measures, one thing which is required is food delivery at every doorstep. Some people may need ration. Some people who are not in a position to cook right now, because of this emergency situation, they should be delivered food in eatable condition. That is something which is required, because the measures yesterday which were decided, they'll start with a bit of lag. But what we need is emergency help. Now for businessmen, yes, businessmen are under a lot of stress. I mean, bank loans is one thing. Apart from that, their finances have run into lots of issues. So I think for businessmen, the government needs to do two things. One is huge concession in income tax and concessions in GST. These are the two things the government needs to do, even if it means higher deficit, which I have been maintaining across all channels in all my shows. So this is a
I remember you told me yesterday that your first advice was control the fiscal deficit, but for now you're saying don't bother about the fiscal deficit, just make these announcements. Okay, we'll have to leave it at that. Akash Jindal, we're completely out of time. Economists, thank you for joining us on NewsX there with your reaction and your reading of the RBI governor's announcements. Our big focus on this